9 days ago, well, probably 10 when you're listening to this, OSFI made a statement at their industry day that had mortgage advisors, investors, realtors, and Reddit threads going absolutely freaking nuclear. They said that income being used for one mortgage can't be used for another property. But this is where they left things out. The consensus interpretation was that if you had a mortgage on your primary residence, you couldn't use any of your employment income for a second property. That would have been a death of a small investor in real estate, as you probably know. But later on, OSFI actually clarified, and the reality is more nuanced but still significant. You can use your income for multiple properties, but only the portion you're not already using. So essentially what they're saying is that while there isn't a direct impact to the underwriting guidelines, they are re-clarifying the purpose and the use of income on rental properties. I'll break down exactly what OSFI actually meant and, of course, how this actually does impact rental investing going forward, and why I think this is part of a bigger regulatory shift that investors still need to understand. Now, as I'm recording this episode, there is still further clarification to be required. So you'll probably hear more from me later this week or next week if you're listening to the podcast or YouTube, which is a quick reminder to subscribe if you aren't already doing so you can always get the best information right to you. Now, I'm supporting this data based on the capital classification rules for November 1st for the big six banks. And this matters because regulatory environment for rental property investing is, like I said, fundamentally shifting. Let me give you the exact scenario OSFI clarified, because yes, the details matter here. Now, our partners at Mortgage Logic News, specifically Rob McLister, contacted OSFI 9 days ago and literally just got the final response on Friday, October 3rd, after a week of frenzy of basically every lender, underwriter, and person in the industry not really understanding what was going on. And I will clarify, I spoke to Rob on the 4th of October, and he explained to me that we were still waiting for further clarification, which I agree on. Now, in OSFI's example, written as if you earn $1 million annually, right, like there's a lot of people doing that, and have a primary residence mortgage that requires $100,000 to service, you can use the remaining $900,000 to determine if the new rental mortgage should be classified as materially dependent on cash flows from the property. Let's break that down into what this actually means. So first of all, this means that your income can be used for multiple properties. It just can't be quote unquote double counted among additional properties. OSFI explicitly said this time, wish they said this in the beginning, at this time there are no direct underwriting implications of this guidance. It is solely for determining whether a mortgage needs to be classified as material dependent on cash flows generated by the property. Let's keep breaking this down. I don't want you guys to fall asleep here. Stick with me. The classification actually kind of matters because a loan, which is considered income producing, which means that at least half of the income used to qualify comes from the property itself after stripping out income already used for the mortgages, that requires banks to hold more capital. So banks have this thing called capital reserves, which is kind of like the backup plan if things go sideways. And OSFI kind of essentially forces banks to set aside more capital for a higher risk potential loans, and essentially increases the requirements of money that they have to have available for certain loan types. Now, this will have an impact ultimately, but let's keep going. Here's what it's actually really talking about. OSFI, they want to identify which mortgages are materially dependent on cash flows generated by property, because those require banks to hold more capital. Now, this is foreshadowing, but part of the reason I truly do believe that rental property mortgages fundamentally will start to change in our country to being more of a residential to a commercial holding requirement. Of course, this is just my guess, but I do think we're going to go down that road in the long run. Here's how this works. The 50% test works like this. After you strip out income already used for other mortgages, if more of half of what's left from the rental property itself, that loan gets qualified as income producing. This matters because it gets determined like to be treated higher in terms of capital requirements, so the money the banks have to have available. And when a loan basically, so a mortgage gets classified like this as this income producing loan, there's basically a weighted risk that they put on these loans, and it goes from 35 to 50%, and that's obviously a massive amount of increase in the money that banks have to hold for these types of loans. Of course, one of the big six bankers, in this case, told the news article, or told Mortgage Logic, holy cow, that if this results in more than maybe 0.05 to 0.1 beeps or basis points higher impact on rental pricing, they might be surprised. But keep in mind, even just a fifth of a basis point, so 0.05% on a $650,000 loan is over $1,500 of extra interest over the term, notwithstanding the fact that you need a slightly higher amount of income to qualify for that loan. There's obviously further ramifications, but that's like the initial guesstimate that they're probably going to price rental mortgages a little bit higher because of this impact. Now, here's why I'm calling this the potential of a fundamental change, even though it's not the doomsday scenario that we were hoping, or nobody was hoping, that we thought might happen last week. Under the old system, if you made $150,000, had a $60,000 mortgage, banks would look at your total income and total debt somewhat holistically. They'd see strong income, manageable debt, and approve additional rental properties, as long as you qualified based on the guidelines. And banks these days have pretty strict guidelines anyways as it considers rental properties. So again, this doesn't necessarily have an immediate impact on the underwriting guidelines from the banks. But with a level of income segregation, there is the higher likelihood that this is going to trigger the loan as a income producing loan, which basically affects more or less just rental properties. And essentially, the way it was explained from this banker was, again, the highest likelihood immediately is just that they start to price these loans a little bit higher. But the slippery slope that could happen is if there is additional income. So for example, if property one needs $30,000 income to qualify and you've got $90,000, so only 33% comes from rental income, 67% from employment, that's fine. That's under the threshold. Property two needs another $30,000. Now you're at $60,000 of your $90,000. Your third property, you only have $30,000 employment left, so you're at 50% rental income threshold, where it becomes income producing with higher capital requirements. Again, this is most likely to be impactful for those where they're using a higher amount of their income towards their properties, which means they need a higher amount of rental income to qualify. Under the old system, it let you build larger portfolios before you're hitting any constraints. Under this new system, it creates a mathematical ceiling around 3 to 4 properties where cost starts to increase. But the truth is, this we could have seen coming a long time ago. Banks have been tighter and tighter and tighter on lending guidelines for a long time. And these OSFI guidelines aren't a direct requirement to change the underwriting policy. But if this does impact the amount of cash or capital that banks have to hold for every loan, like I said, not only is this going to increase the cost for the borrower, it is likely going to increase the qualification guidelines, meaning the amount of money that you have to have in your income to be able to qualify for said property. Now, on the big picture perspective, I think what we're seeing here is OSFI is just trying to get ahead of a problem that they're seeing coming, and that problem is what they consider to be over-leveraged property portfolios in a weakening rental market. We've been calling this for the better part of the last 24 months. I think they're just late to the game in this case, with rental vacancy rates rising and rental growth slowing and government borrowing at freaking crisis levels right now. They're just tightening things up. And they're basically looking at the economic backdrop of rental vacancy is increasing and the supply is flooding certain markets like Toronto in this case. And interest rates have made rental yields relatively terrible. You're not making a lot of money on rent anymore. I think what it is at the end is they're getting nervous, and banks are getting nervous about rental property exposure. And we're seeing it right now in the risk of a lot of these banks being reduced. And so again, this is not a significant material change, but I do believe it will lead to a slippery slope in the long run. The guidelines are effective November 1st, which is OSFI's way of saying, banks, you need to hold more cash, more capital against rental property loans because we think they're riskier than you're treating them right now. And, the truth is they probably are right. When you look at rental properties that were purchased in 21 and 22 at the peak prices with low rates, many of those massively negatively cash flow now. Like, it's backwards. And if we hit a recession and tenants can't pay loans, they start defaulting. And really, at the end of the day, their job is to protect the system. And that's what they're trying to do here. So basically what happens next is that starting November 1st, The big six banks have to implement these new class rules, which is again not surprising. So here's what I expect to see more in practice. First, rental property mortgage rates probably go up 0.05 to 0.1% above the already they already have a premium, so an additional 0.05 to 0.1% on a premium in higher capital requirements. Because of that, it's not catastrophic, but it is measurable, it is impactful. Second, there is no guarantee this is the case, but I would like, again, when you think about this happening, I would not be shocked or surprised to see underwriting for these loans become a little bit, even just a touch more conservative for these quote unquote income producing loans. Maybe it's on the second, maybe it's on the third, maybe it's on the fourth property, but I think banks are going to be really, really conscious of wanting stronger cash flows and higher down payments and better credit scores. We've already been witnessing this. Even if it's not being spoken about right now publicly, this has been going on for the better part of the last 12 to 24 months, and specifically the last 6 to 12 months. I've seen it in terms of banks saying, we don't want this. We don't need this business, which ultimately means more of these files will ultimately fall into the alternative lending space, maybe the credit unions, but probably alternative lenders and the non-OSFI regulated lenders, therefore increasing potential costs to borrowers. And the other thing that I think is this probably accelerates the shift towards institutional ownership of rental properties. I said it before, even if it's a tiny little thing, even if it's not a major impact to rental classification and underwriting, they're just continuously reminding us that they don't want us to have any ownership of additional real estate, or they're making it sound more risky, which means that in the long run, we probably do see those institutions with different capital structures continue to buy. And this is not going to be the case for everywhere. It's going to only make sense if it makes sense for them. But again, there is going to be an impact. It's interesting. There's been two sides of people talking. On one side, people are like, oh my gosh, I'm never going to be able to buy a rental again, which honestly, based on the feedback they shared, was probably a fair assessment. But now knowing this, on the other side, people are going to argue that it's wrong and they shouldn't allow rentals. And it seems like it's a pretty divisive issue at this point right now. Now, the key is if you are building a rental portfolio, you kind of just need to know ultimately that this income rule classification may not have a significant impact day one, but it will definitely draw some level of impact over the near future, whether it be a cost perspective or a slight difference in your ability to qualify. You want to understand this information better, you should work with a mortgage professional who is constantly doing research on understanding these types of calculations, and of course, making sure to be on top of this news because it's just coming out bit by bit by bit. We need to be aware and on top of it. The second is you need to recognize that as your portfolio grows and more loans get classified as income producing loans, it could mean ultimately that your cost of capital goes up. And you want to build that into your investment return calculation. So if you are someone that invests, you should be aware of that. The third factor is that you should consider your timing. If you're planning to add these rental properties before November 1st, it might mean that you get better rates and terms before banks fully implement the capital rules. I'm going to pause on that and say, through everything I've just shared with you, this is perspective. It is perspective. We need clarification still. We need more information. I'm just sharing the facts that I know and the information I have and my feedback based on what we know and what we have at this point right now. The other factor here is just, I think we need to acknowledge that in this environment, the shift is against small rental investors. That doesn't mean you cannot invest in real estate, but it definitely means there are some headwinds that you will be facing long term. So the truth is, OSFI's clarification means the situation isn't nearly as dire as the initial industry day comments suggested, and you can still use your employment for rental property mortgages. But make no mistake, this is still a change and it still is an impact in the marketplace. The capital classification rules, the income segregation requirements, and this quote unquote test means that there will be some impact on rental property mortgages, even if it is nowhere near as dire as we initially thought. The bigger picture at the end of the day here is, even if there was no underwriting change, is the truth is that OSFI sees a risk in the rental property market. I'm not surprised by any of this, and they're taking bigger steps to protect the banking system. Now, whether you agree with this approach or not, the regulatory environment, it's changing and it's tightening. And for small business or small real estate investors, it ultimately means being smarter about building your portfolio, whether it's construction or understanding the capital costs and recognizing that the easy money of rental property investing is over, undoubtedly, at this point right now. Now, I've had a crazy amount of people talk to me about commercial loans and where they fit into the real estate environment in Canada. We're going to do some content on that in the coming weeks. So if you'd like to see more of that, give me a thumbs up or let me know in the comments if you're watching on YouTube. If you're on Instagram as well, you can find me at themortgagepug and let me know your thoughts on the recent episode. Love to hear some feedback for you. Also, give me a great rating if you can on iTunes or Spotify if you're enjoying these episodes. We'll continue to keep you up to date. Lots more coming. We'll see you on the next show. Thank you, guys.